Hey everybody, apologize for starting this just a little bit late. We're having just slight audio issues on our end, but we should be all set to go. We're super excited to be doing this one today. We've got Morgan Ray with us from Bookkeeping for Trades. Morgan's an unbelievably incredible individual who knows her stuff like you wouldn't believe. We've had a number of conversations with her. They're a partner of ours at Hearth, and frankly, there's somebody we lean on for advice on a number of different topics. This happens to be one of them. So super excited to have her on board. A couple housekeeping items while we're getting through this. Clearly, some of you guys saw that there's a chat section. I want to make sure that everybody understands this is for you guys. Like, you took time out of your day. You want to learn more about this as we go through this. These conversations are infinitely better if you guys actively communicate. So by all means, if you guys can hear us and the audio is working out well, feel free to just go in, throw a, hey, what's up? Yeah, we hear you in the chat section. And we'll get this thing rocking and rolling. But the topic we're going to be talking about today, you guys, are the 4 biggest tax traps for contractors. And this is one of those guys. We have over 11,000 contractors as active members of Hearth. It's actually more like 11 and a half. But you know, this is one of the topics that we hear all the time that people run into pitfalls. It's scary. There's a lot of unknowns. I mean, speaking tax is like speaking a totally different language. So again, it's no surprise that when a lot of our contractors are actively prepping for tax season, there's a lot of these kind of WTF moments that typically equate to, in some way, shape or form, to money lost. So what we're going to do, like I said, we'll jump directly in. These are the 4 main things that we're going to cover today. I'll obviously do some quick intros so you guys can get to know Morgan a lot better. You've probably seen my face way too much, which no one really joins these webinars to see. But the long and the short of it is we're going to go through the 4 tax traps. Guys, these slides are designed to not be full of words. They're designed to let Morgan do what she does best, which is elaborate on all the different things at the level of professionalism that she can bring to the table. So again, she's the subject matter expert. We're going to lean on her. Ask questions as we go through this. Again, you guys took the time out of your day. If you have questions as we go through these 4 things, or you want us to elaborate a little bit deeper on something, tell us. And then beyond that, we're going to leave you with action items. You know, what good is it to tell you what the 4 tax traps are without giving you 4 takeaways at least to go out and do within your own business? So we're going to go through those action items, then we'll open it up for Q&A. Shouldn't take us the full hour, but honestly, we want to make sure we have enough time just in case if you guys do have those questions, we can go as deep as you want. So feel free to use the chat in the question section. I'll be moderating it the whole entire time. And without further ado, let's dive straight into those intros. So Morgan, I'm going to pass this one over to you. I'm the nerd running the projector, you guys, so she'll give me a little thumbs up when it's time to change the slides, and we'll just start rocking and rolling. So Morgan, feel free, introduce yourself. Thank you again for taking the time out today.
Absolutely. Thanks so much for having me on, James. Over here at Bookkeeping for Trades, we're really big fans of all of the work that you guys do over there at Hearth to help contractors with really savvy financing solutions. One of our big focuses as accounting service providers that really prioritize a niche into helping specialty trade contractors of all types is that we're really keenly interested on trying to identify the different areas that are common traps that contractors fall into, like we were just discussing. This is a really great opportunity for us to talk about it in the realm of tax stuff. But you know, there's a lot of different things in the realm of financials that can be really difficult for business owners to navigate. So we're just really grateful to have partners like you over there at Hearth that are in that exact same boat, trying to make things easier for business owners and just making that cash flow a little bit easier all the way around, since it's the lifeblood of the businesses. So a little bit more background on me. I am one of the managing partners over here at Online Bookkeep, where we do business as bookkeeping for painters and bookkeeping for trades. So we entered the specialty accounting services scene about 6 years ago, and we started working primarily with painting contractors under our Bookkeeping for Painters brand. Really love working with painting contractors. They've been our bread and butter for a long time, but in the last couple of years, we have expanded our service offerings to take on other contractors of all types. So Anybody out there in the landscaping, roofing, general contracting, tech integrator space, we've got a lot of variety in the types of contractors that we work with, but a lot of really common themes and struggles that come into that. So at Bookkeeping for Trades, essentially we focus on cloud accounting. We help business owners move and convert everything that they can in their record keeping sphere onto the cloud. This can really help streamline, make a lot more things efficient. And so we go in and we do full service bookkeeping services on monthly and weekly packages. We also have a full service tax team department. And then the final component of what we do is very heavy on advising. So over here at Bookkeeping for Trades, we have we place a really strong emphasis not only on helping you dot the I's and cross the T's when it comes to all of your accounting, but to take all of that data that's running through your business and try to translate it into something that's actually usable, information that you can actually make really good decisions off of. So that's the focal point of everything that we do over there at Bookkeeping for Trades. If you find any of the information in this tax webinar useful, definitely would be happy to connect with anybody who wants to reach out and see if it seems like a good fit for a deeper service relationship there. All right, so what we're going to do today in today's webinar.
Cool. So you guys, we're going to dive straight into these 4 traps. And again, this is one of those things that when we connected with Morgan, not only are these what our customers are running into at Hearth, these are a lot of the things that they see continuously again and again as they work with people from literally any vertical. Hearth, if you guys didn't know, has like 50 different verticals represented within our suite of customers. So literally anything you can imagine within the home services or home improvement space, our financing tools are used to support those customers. But again, these are the 4 main that they run into. This is their profession day in and day out. So again, I'm going to let Morgan run through these. When I see that thumbs up, we'll keep going through, starting with the time trap. So Morgan, take it away. Thank you.
Thanks, James. So out of the 4 traps that we're going to spend some time on today, the time trap is the first one. And you'll notice a lot of consistencies, and basically these traps all kind of play in together. So we're actually going to spend the most time today talking about the time trap. And what I mean about the time trap as it applies to the realm of tax issues that small businesses face, and actually not just small businesses. The time trap is the exact same issue that people face on the business side as well as the personal side of taxes. And what the time trap is just hitting deadlines and sometimes crossing deadlines for things that they aren't aware of or that they weren't prepared to actually meet in a way that they need to in order to avoid a lot of the interest and penalties that can come along with missing these deadlines. So at the crux of everything, what I like to tell people who are struggling on the tax side or anything like that in their business is that there's always a solution. There's always something that we can go in and do. If you have let things slide for years, there's always a way to go back in, recreate records, and get things done. But what's really hurting people is actually missing those deadlines and all of the penalties and things that start to stack up really, really quickly when you're not prepared, especially because so much of this area of tax law is really opaque. It's not obvious. There's a ton of different filings and things that you're responsible for as a business owner as well as an individual. And it can be so easy to lose track of a lot of those specific due dates. And then we start running into, the penalties and the interest and the different things, and they can stack up incredibly quickly. So the time trap, the biggest thing to think about here is that, number one, we really need to make these deadlines obvious. We really need to have a firm grip on what are the expectations that the government, state and federal governments have for me as a business owner as well as an individual. Make sure that those deadlines are very present in your mind and that you have a plan in place for continuously meeting them. Who is going to handle this obligation for the business? When are they going to do it? How are they going to do it? And that's going to be one of the central focal points that we'll talk about in a little bit. So when it comes to deadlines, we have 3 main types of returns that I like to talk about. So this time of year, everyone's pretty preoccupied with the income tax returns, but in reality, we're juggling a few different types of returns as business owners. And it's really important to not let things like our informational returns or those payroll obligations slide by, because they carry pretty much the exact same weight as those income tax returns that really get most of the focus and priority. So when it comes to income taxes, we are juggling income taxes on the business side as well as the personal side. And there's a lot of intermingling for most of the small business owners that we work with, probably just like most of you, who have what we call pass-through entities, which is where the business income passes through the business straight to you as an individual or you and your partners, and then you pay taxes on that side. So the first thing that I want to talk about when it comes to income taxes is relevant for us as business owners and individuals, and it's those estimated taxes. So this is one of the first areas in tax law that gets kind of crazy because we're essentially we're on a pay-as-you-go tax system here in the US. So what that means is that, when it comes to filing time right around March and April, the IRS expects you to have already paid your taxes for the last year at the time that you make that filing. It's a really odd expectation since the way that we calculate taxes is very, very involved, and you often can't tell exactly what your tax bill is going to be until you've actually done the full preparation and filing and the year has wrapped up. But nevertheless, they still expect you to have made payments towards that. So the estimated taxes are a really big thing that we want to touch base on. You are expected to make payments on your income throughout the year based on quarters. So the first 4 deadlines and due dates that we want to be aware of are those estimated tax deadlines. The first estimated tax deadline that you have in the year is right after New Year's. It's January 15th. So January 15th, you have a due date right there that you're supposed to be making a tax payment on Q4 for the prior tax year, okay? So it's the first tax payment that you need to make in the year, but it's actually for the prior year, but we don't want to let that slide by in the mix of the holidays. So we've got a January 15th estimated tax payment due date, and then it starts for the current tax year, and you need to make payments on April 15th, and then June 15th, September 15th, and then when the year wraps up, you have to make that the final payment for the current tax year before January 15th of the following tax year. So that's a really important thing to keep in mind. And this is a really tricky area because, like I said, we're really working on a lot of estimates right here. We're really trying to predict what we think we're going to make. We're trying to predict what kind of write-offs we're going to be taking advantage of before the end of the year. And we have to hit some specific thresholds so that we're not getting hit with penalties for underpayment of that estimated tax. And we'll talk a little bit more about exactly how to avoid some of those penalties in just a minute. But that's the first set of due dates that we want to keep in mind. I actually really like to tell people a lot of the time that everyone sort of panics about April 15th as tax day, but for business owners, honestly, it's almost the entirety of Q1 that's just chock full of different payroll deadlines, or not payroll, tax deadlines. So we've got that January 15th tax deadline for a payment, and then we have a January 31st deadline for informational tax returns. So that's going to be our W-2s or our 1099s. I think this is another area that for a lot of business owners, it can be so easy for that to slide by. You're really busy getting prepped for production or doing winter strategizing. And if you haven't been prepared with the information that you need to file 1099s, it can be really tricky to try to wrangle that information from your vendors or subcontractors that you need to file those for. So that January year to get those informational filings filed. It looked like I lost my connection for a second, so I'm just going to reiterate that, which is that when it comes to these early in the year tax filing deadlines, it's even more important to make sure that we're prepared with all of the information that we need in the prior tax year. We want to make sure that throughout the year we're collecting the information and preparing to be ready to make those filings, because if you haven't, it's going to be really hard to get that done so early in the beginning of the year, right after everybody kind of gets back from the holidays. So in January, we've got that estimated tax payment. The end of January, we've got that informational return deadline, January 31st for your 1099s and your W-2s. We'll talk a little bit about the penalties associated with those in a minute as well. And then we get into our income tax return deadlines. And we've got different deadlines for some of the business returns, different deadlines for the individual returns. So most of you are probably aware, if you have a pass-through entity, which is an S corporation or a partnership, where you have to coordinate all of the business's financial information and then give specific income and expense information to each of the partners so that they can then file their personal taxes, your deadline is sooner than April 15th. So if you're on a standard calendar year, business tax return deadlines for a partnership or for an S corporation are going to be on March 15th. And if you're on a fiscal year, it's going to be that 15th day of the third month. That's going to be the common thing that we see there. This is a really important deadline because if we're not able to file by that time, and oftentimes that's a huge struggle for businesses who are trying to wrap up their accounting for Q4. They may not have a formal bookkeeping or accounting system in place, so they're trying to juggle a lot of paperwork right as they prepare for the busy part of their production season. If you're not prepared to make that filing, we really want to stay on top of getting an extension filed. And I'll talk a little bit about extensions are something that you can get for an informational return. If you're not prepared to file your W-2s or your 1099s on time, you can sometimes file for a brief 30-day extension to give you a little bit of wiggle room there before you start getting into penalties. But for the business returns, it's incredibly important to make sure that you are prepared and you file an extension for that filing before that deadline, because otherwise the penalties are going to rack up really, really quickly. And again, I'll talk some more specifics about the penalties here in a moment, but we want to stay on top of that one. Very similarly, that April 15th deadline that everybody's used to for their individual taxes, at least that one sticks in our mind. Everyone's pretty much aware of that. Same thing. If you are not ready to file, make sure that you're proactive. Get that extension filed. For either one of these, the business returns or the individual returns, filing that extension, automatic approval. It gives you 6 more months to make sure that you have all of the information that you need to get that filing in on time. And it's a given, like it doesn't need any special approval, just get it in on time. If we miss that deadline, you're done. No extension can come around after the deadline. You've got to get it in before. And we want to make sure, got some feedback coming through. Want to make sure that we get that extension.
Yeah, that was me, my bad.
No problem. Can you hear me now, James? Awesome. So we want to make sure that we get those documents in. Now, the big thing to remember is that when it comes to your individual taxes, whenever you are filing for an extension there, you have 6 more months to file, but it's an extension on your time to file. It's not an extension on your time to pay. So you're still considered to have that April 15th due date for all of the taxes, for your tax liability, the whole thing. If you haven't been making sufficient estimated tax payments or you didn't have enough withholding, there might be a chunk of change that's due at that point. So it's really worth your while to try to pay as much as possible towards your tax bill whenever you submit that extension filing, and then give yourself a little bit more time to finalize those numbers, make sure that everything's really tight, get that filing in. And if you overpaid whenever you filed for an extension, you'll get a refund. You'll get a nice little refund back from the IRS. And sometimes they will even pay you interest for anything that you overpaid once that calculation is done and settled. So that's kind of a funny thing that a lot of people may not be aware of. So in terms of deadlines, we've touched on estimated tax deadlines. We've talked about those informational return deadlines, business return, personal return. Very heavily stacked at the very beginning of the year here, you guys. Now, the reason that these deadlines are such a huge focus and a huge priority for me, especially as a tax practitioner, is because honestly, you guys, it's pretty scary how quickly penalties start racking up for these things when it is so easy to miss a deadline, get busy with production, and just think, I'll get to it when I get to it. But a lot of these penalties start stacking up month by month, and then they start to actually increase the more time that goes by when you haven't done that filing, if you haven't done that extension, and if you haven't paid some of those taxes. So to just really kind of hit this point home a little bit more, I want to spend a little bit of time talking about what's at stake here. What is this costing us just by missing a deadline? So whenever we miss a deadline for an estimated tax payment, and this is a huge one that people really struggle with because of the fact that like I said, it's not super easy to calculate. You don't always have a tax advisor that's consistently reminding you about what you need to pay, when to pay it, how to pay it. So if you're not making those estimated quarterly tax payments sufficiently in the IRS's mind based on what your final tax bill ends up being, they're going to assess you a 3% underpayment penalty for anything that you haven't paid. And they're going to look back at when you earned income, and they'll usually allocate your income throughout the year, and they'll say you should have made a bigger payment in Q2. So at the point of that Q2 deadline, when you didn't make a big enough payment, we're going to take how much we think you should have paid, and we're going to start assessing 3% penalty on that. and they'll start assessing interest on top of that penalty as well. So you'll see that as a consistent theme. Anytime you haven't paid them, they will start assessing you interest on what you haven't paid, as well as any penalties that you have accrued. So the party gets really fun really quick, right? So that's the one for the estimated taxes, 3% underpayment penalty. What really gets people, however, is those failure to file penalties, like I said. So I'm going to just kind of break these down one by one. I'm going to go ahead and start with our income tax returns. So whenever we are looking at a business tax return, there's a couple of different penalties that come into play here. Failure to file, failure to pay, and in some cases, failure to furnish an informational return to partners with the K1s. So the business returns is where the stakes are really high here. Whenever we are looking at, let me pull my notes up again really here to get you guys the most up-to-date numbers. So as you can imagine, the IRS likes to change things up on us pretty frequently here. So whenever we are looking at any sort of business tax return that has partners involved, so that's going to be a partnership or it's going to be an S corporation, you have to furnish each one of those partners with a K1, which is that informational part of the return that tells them this is what your income was, these were what your non-deductible expenses were, all of that feeds into their personal return. If you miss the deadline on March 15th for a partnership or an S corporation return, if you miss that deadline, you don't file for an extension, every single month and every single partner is going to earn you a $210 penalty. So every partner, every month. That starts to stack up really, really quick. If you've got two partners, you miss 1 month, you're sitting on a $500 penalty. That's going to keep going month by month by month, stacking up until it maxes out at that 12-month mark. So if we go a year without filing a partnership return with two partners, we didn't file an extension, we're looking at over $5,000 in penalties there just for not getting that submitted whenever it needed to be submitted. That is a steep price to pay, my friends, for possibly missing something and then just thinking that you'll get to it when you get to it, in addition to all of the taxes that you have to pay and the interest that might be associated with that. So those K1s are a really big one that I really like to remind people on, that if you're gonna, we might be juggling a lot of balls, as my business partner, Melissa, likes to say frequently, we're all juggling a lot of balls and you've got to figure out which ones are glass and you really can't drop them versus which ones are rubber and might be able to take a quick hit before you pick it back up. In my opinion, these business tax return filings, when there are K1s involved, that is definitely a glass ball that we cannot afford to drop. Get that extension filed. It's super quick and easy. In my opinion, a lot of tax preparers may not even charge you to assist you with filing an extension, or it's pretty easy to find somewhere to do it online. So those are some practical tips there. Just buy yourself some more time. Just don't miss that deadline because the penalties really start to stack up quick. With other returns, such as your individual income tax return, or when we start talking about payroll returns here, if you don't do a filing like you're supposed to, so this is really common for payroll, your quarterly payroll filings, your annual payroll filing, or your individual income tax return, usually your failure to file penalty is actually going to be about 5% of whatever your unpaid taxes were every single month. So 5% of whatever you didn't pay, it's going to start stacking up. But they have a couple of minimums on there too. So if your return is 2 months late, then you're going to pay a minimum of around $435 in failure to file penalties there. A little bit of allowance if you're a really low income earner, or if your tax bill is really, really small. If it's less than that $435 number, they'll cap you at whatever your tax bill is for that minimum penalty. But for the most part, for most people, we're looking at least a minimum penalty of around $435 just for being a couple of months late there. So again, money that we are leaving on the table just because of timing. It's something that we have to do. It's going to get done at some point, but if we can be a little bit more proactive about being prepared and making sure that we get things in on time, we can save ourselves a lot of pain and heartache and wallet ache in the process. That 5% for your unpaid taxes will keep accruing every month, and then it'll cap out at 25% of whatever your tax bill is. So it's not gonna cause you too much pain maybe there long term, depending on what your tax bill is. But As we know, cash is the lifeblood of businesses. And if you have a kind of gnarly tax bill coming your way because you've struggled to plan for what you're going to owe and you weren't making estimated tax payments, and then you realize that you had this late filing and it's accrued 25% of what you already were struggling to pay, you can see how this is really a slippery slope. And that's really what gets people when it comes to this accounting and this tax side, is it's just one little thing that can be kind of tricky for you, and then it just starts to stack up year over year, and it can feel really hard to get a plan in place and make sure that it's addressed so that you can get your feet under you solidly for the next time this cycle comes around, because it comes around every single year. So it's well worth your time and your effort and energy to just put a solid plan in place once, follow it every single year. So that failure to file penalty, that's what we're looking at, about 5% of your unpaid tax, caps off at 25%. Failure to pay. So filing is one thing, paying is something else. If you file an extension, but you don't know exactly what you owe, that's definitely a much better scenario to be in, because your failure to pay penalty is so small. It is 0.5% compared to that 5% that we were just talking about for failure to file. If you don't pay, they're going to take a look at what you didn't pay in taxes, and a little 0.5% is going to be what they assess for you every single month. And again, that one caps off at 25% as well. Now, even better than that, if you can't pay your tax bill for some reason because it's more than you anticipated, as long as you get your information put in and filed, you can apply for a payment plan with the IRS, and then they'll shave that penalty down by half. So instead of paying 0.5%, you'll pay 0.25% on whatever you owe every month while you make payments on that to the IRS. So as I like to tell people, at the end of the day, the IRS is mostly concerned about getting some money from you. They do not want to crush you into the dirt, because then they're not getting any tax revenue from you. They want to give you a path. They want to give you an out. They want to see that people are making an effort and trying to be communicative with them and acknowledge that they have different kinds of tax burdens. And funnily enough, a lot of forgiveness can come from the IRS if you're being proactive about making a plan, when and how you're going to pay things. It does a lot to diminish any of these potential penalties and things that you're going to be dealing with. So that's the other big part of this time trap piece, is don't think that you have to have it all together at once. Reach out by these deadlines, let people know, let the IRS know where you stand on some of these different things, and put a plan in place with them to make sure that you're going to get these filings and get these unpaid tax liabilities paid to them. And that's going to do a lot to alleviate the burn that we might face in some of these cases. Information returns. So we're kind of segueing off from the income tax returns. 1099s, W-2s. Like I said before, this deadline is right at the beginning of the year. And to get these filings done, you need to have some information from these vendors or from your employees. So you need to have things like their legal names, their addresses, their tax IDs. And a lot of contractors struggle because they haven't been collecting these from the vendors throughout the year. And they're trying to message them around the holidays. They're trying to email them around New Year's, trying to get these W-9s in, which is the way that those vendors give you that information on themselves. And sometimes they don't really have a care or concern for getting it to you very quickly. And that's a really big struggle for anyone who is trying to get this informational return filed on time and avoid these penalties for missing them. These 1099 and W-2 penalties for not furnishing them to the people that you're meant to send them to, because you have to send them to your vendors, to your employees, as well as to the government, so that everybody has the information that they need to file their own taxes. They are steep, and they increase very substantially the longer that you take to get them filed. So if you miss that January 31st deadline to furnish people with their 1099s or their W-2s, you're looking at $50 per item that you didn't get to people. So if you had 10 subs that you didn't get 1099s to by January 31st, we're looking at a pretty steep $500 in penalties just for that first month. If you go more than a month, then you're looking at, it doubles, $110 per item that you didn't get out whenever it was supposed to be. And that $110 per return per 1099, that number sticks until you hit 6 months. Once you hit August, it doubles again. Now you're looking at more than doubles, $270 per 1099, until you get to, it sticks at 270 until you finally get those furnished to everyone. Unless the IRS comes back and says you intentionally disregarded your obligation to send this information out to everyone, at which point they'll double it on you one more time. So if they come back and they say that you were intentionally disregarding your duty, then you're looking at $5,000 for every single one of these 1099s that you didn't send out. The truth of the matter is, everybody, that 1099s are a pretty easy thing to get done. If you're doing even simple bookkeeping and simple tracking of what you're paying people, you can use some services online that are really quick and easy. They walk you through, kind of like TurboTax. They'll just walk you through typing in a few key pieces of information. They'll charge you $3, $4 per 1099 to make sure that everybody receives them. They're all filed, they're e-filed for you. So again, it's just about having that information ready when you need it so that you don't have to waste time going back and backtracking, because that time wasted can get incredibly expensive for you whenever we're talking about missing some of these deadlines. Payroll returns are going to be very similar. Most businesses have quarterly filings and they have an annual filing. Most of the time you need to have these done. These filings need to be submitted within 30 to 60 days after the period wraps up. And you guys, you have these on the federal level and the state level. So don't forget about the state deadlines in the mix here too. I haven't talked about them as much, but all of these different things, the 1099s, the income taxes, the states have very similar requirements. They're not always the same as the federal. So again, that can be a really good area to be really aware of and make sure that you have the right resources and the right people, the right coaches in your court to help you kind of juggle all of these different obligations that you have. For payroll, mostly what we're looking at there is you can have a failure to file penalty. It's going to be the same 5% that I was talking about before, 5% of those unpaid taxes. That's consistent. You can also have a failure to deposit penalty. So with payroll, you are withholding different kinds of taxes from your employees' paychecks, and you have an obligation to deposit those with the different taxation authorities at different points. And that can vary. Some of you guys might be on a semi-weekly, you might be on a monthly, you might be on a quarterly deposit schedule. And fun stuff, that deposit schedule can change on you kind of last minute sometimes. And if you're not depositing those properly, you're going to be paying anywhere from 2 to 15% of what you owe just for not depositing it on time. So you guys can see, again, these molehills turn into mountains really quickly it's just a matter of timeliness. It's just a matter of doing things on time. So those are the really big penalties and things that I like to make everybody aware of when it comes to all of these different deadlines. The last thing that I do like to do an extra mention of, though, when it comes to payroll returns, this isn't a filing trap so much, or at least it's not about a filing. But when it comes to payroll taxes, if you don't have a good system in place for handling all of your payroll obligations and getting those taxes remitted, and this is also a common problem that I see a lot of contractors struggle with. There's a special type of penalty that comes into play with payroll taxes when it comes to what the IRS calls trust fund taxes. And what they're talking about here is whenever you withhold money from an employee's paycheck that's supposed to go to the employee's portion of their payroll taxes or their income tax withholding, the way that the IRS looks at that portion of their withholding is that that is your employee's money that your employee has earned, and you are withholding it from them, and you have an obligation as an employer to send that to the government on your employee's behalf. When you withhold that from the employee and you do not send it to the government on the employee's behalf, they consider that to be theft. You have stolen money from your employee and you have stolen it from the government and not sent it to them. And if they come through and they find that you have had an intentional disregard, again, to do this, they say that you knew about your obligation, you withheld this money, and you didn't send it to the government, even though you knew that you had an obligation to do that, you personally, or anybody in your business or organization who could be considered to have been personally responsible for that, can be liable for up to a penalty up to 100% of whatever is owed here. So knowing what we know about running payroll, if we go a year, let's just say a year with a few people on the team, and we're not remitting income tax withholding, payroll taxes, this can very quickly, this number can start getting into the tens of thousands before we know it. And it's unique in that this trust fund recovery penalty tax, you're personally liable for it. You're not going to be protected by an LLC or anything like that. You don't have to be a business owner. They can come after multiple partners. They can come after a chief operating officer. They can come after a bookkeeper or an accountant if they think that if they say that that person had the ability or the responsibility to make sure that these funds were appropriated properly. So this is a really hairy area. My biggest recommendation when it comes to payroll is to find a professional. And so that takes us over into our solutions page here. It's a lot of scary news that I just threw at everybody. So let's spend a quick minute talking about how we can address some of those fears and concerns. I started off the discussion around the time trap with this reminder that, or with the note that really what we need to be aware of with this is reminders. There's a lot of deadlines that we're juggling around. The saving grace here is that most of the time, these deadlines are incredibly consistent. They are exactly the same every single year. It's funny that I'm standing here telling you that, considering that for this year and last year, these deadlines changed a lot. And that's why this has been pretty hellish, frankly, for a lot of people who work in the accounting industry, as well as you as business owners. Due to the pandemic, due to different natural disasters and weather events, these deadlines have been flexed considerably. But for the most part, these deadlines are going to be consistent. They're going to be the same. If you can set up reminders for yourself, whatever your calendaring system looks like, if you have a big old whiteboard system in somewhere in your business, if you just have some great magnets, this is something that my firm actually does pretty frequently, is we design save the date magnets with all of your tax dates, and we send those out to contractors on our mailing list so that you can just slap that magnet up somewhere and you see it all of the time. You know exactly when those due dates are coming your way. Reminders are a really key piece of keeping these things in the forefront of your mind in the hustle and bustle of everything else that you guys have going on. So that's my number one recommendation. The second one's going to be
let me jump in 1 second, Morgan.
Yeah.
Guys, if anybody wants to, I discussed this a little bit with Morgan prior to doing the webinar. If anyone wants a copy of those reminder magnets, drop a little note in the chat section that says, hey, send me one of those, and we'll make sure to reach out with you offline and just make sure that we get your mailing address and all that stuff. We'll do that obviously off the chat section, but reach out to us, let us know in the chat section if you guys want to get a handle on one of those, and Morgan's team will send one to you.
Absolutely. Yeah. We're happy to send those over. Again, we're big believers in just like keeping things at eye level, keep it obvious so that it's always there. It's a constant reminder. The second solution here is going to be automation, and I kind of like to lump that in with going pro. So there's a lot of stuff on here, a lot of things in the tax world, bookkeeping world, record keeping world that can be streamlined, and making a lot of the things that you need to do in order to be ready to hit these deadlines can be made a lot easier for yourself. If you utilize some of the software tools available for you, automate some of the record keeping stuff, work with professionals that can help you set that up, and can help you monitor things that can't be automated, because frankly, a lot of it can't be. But there are quite a few things that can be, and payroll is the biggest one and the easiest one that I like to recommend to people. Outsource your payroll to a really solid provider. I really recommend going with some of the large national providers too. I tend to see fewer issues with those, but anybody who's trying to do payroll in-house, sometimes payroll with smaller local providers, I see a lot more issues that crop up with that. So definitely a recommendation, go pro when it comes to having somebody help and assist you with these filings. We talked a lot about missing deadlines today, but there are also penalties and things that come into place with filing things incorrectly. So as you can tell, there's a lot to juggle here. There's a lot of things that change every single year. And it can be really useful to just not have to think about it and have that insurance and that peace of mind that someone else and some other system that's been designed with this in mind is handling that for you. So that concludes the time trap. All right, our second one here that I like to touch on as far as potential tax traps is the team trap. So I'll tell you what we mean by that here. So subcontractors versus employees. This is a really big one for a couple of reasons. And so I'm going to tie it back to our time trap issue there, which is that number one, if you're working with subcontractors, which a lot of businesses are, we've already discussed the ways in which not having your 1099s and your W-9s prepared so that you can file 1099s and send them out to people can be a very expensive mistake. So I have that on there as the second bullet. I'm just going to knock that one out now. We were just talking about it. W-9s are the little piece of, they're the little tax form or informational return that you give to vendors or you give to subcontractors so that you have their legal name, their address, and their tax ID number so that it's ready and handy whenever you go to file your 1099s. Best practices here, I always highly recommend that contractors do not pay a subcontractor until they have furnished you with a W-9. It's always ideal to have them furnish it to you before you have them start on work. But since you have a legal obligation to track and notify the IRS about any payments that you're going to make to them, you really need to get that W-9 in hand. And often one of the best ways to get that is to keep that check payout dependent on if they furnish you with that critical piece of tax information that you need for them. So subcontractors versus employees. This is a really big area of concern for a lot of people. I'm going to focus in this discussion on the federal perspective. I know that there's probably a lot of people that might be listening to this that their states have some much more strict guidelines, California being a big one. Anyone that has a state that follows like an ABC contractor test, you'll be familiar with that working in the state. That's a much stricter interpretation, so I'm not going to focus on that as much right now. But from the federal level, there are three main sets of rules that the government uses to ascertain whether or not somebody working for you could be considered a subcontractor or should be considered an employee. This is a tax trap because you as an employer have an obligation to pay payroll taxes for employees. These are our FICA taxes, the Social Security and Medicare. You have an obligation to pay a portion of that for anyone who's an employee. If somebody is a subcontractor, they're considered to be self-employed. They have to pay that for themselves. So this is about an 8% tax difference, right? If you are self-employed, you are paying basically 15% in these FICA taxes. If you are an employer, you pay half of it and the employee pays half of it. And so it's half as much of a burden. But for that reason, the IRS wants to be very clear and very careful about who are we considering a subcontractor, who's an employee, for the purposes of, do you owe these employee payroll taxes or not? So the three main rules that we have to look at to decide is someone a sub or are they an employee are we have to look at behavioral control tests, financial control tests, and then the nature of your relationship with that person. So there's a lot of nuance here, but just really high level behavioral control. How much are you telling them exactly how to do, when to do, what to look like, what to wear for the execution of a particular project or job? If they're using your equipment, if they're wearing your uniform, if they're driving your van, if they're showing up whenever you tell them to show up, if they're clocking in and out of your time tracking system, probably going to be considered an employee. Whether or not you call them a sub and they say they're a sub, you might have a contract that says they're a sub, they're probably not a sub. And so we want to be really careful about these things. It happens a lot. Honestly, you're probably not going to bump into a lot of issues with this unless a subcontractor decides one day that they don't want to pay their self-employment tax bill. They go file their taxes and they see a big old 15% tax that's levied on all of their income. And they say, I don't want to pay that full number. I'm going to claim that I should have been an employee and this person that I was working for should have been paying for half of that. That's where businesses get into trouble here with that. So those are 5 really common things that we see in contracting. So just know that if you're trying to work with anyone as a subcontractor, you're going to have all of these branding considerations, operational control considerations, quality control considerations. That's going to play a big role in whether you're working with subs or you're working with employees. And we just want to be careful that we're not treating somebody as one when they should have been the other. If we're treating someone as a subcontractor and they should have been an employee, if the IRS comes back and scrutinizes that down the line, what happens here, what you have at risk is that they say, no, this person was an employee. You skipped out on your obligation to pay payroll taxes. So now we're going to retroactively assess payroll taxes on everything that you paid that person. and you're responsible for paying it, and you're responsible for the interest on it. Not a fun conversation to have, as I'm sure many of you can imagine. So that's why it's really important to make sure we're categorizing people properly. So those behavioral controls are the biggest one that trip people up. Financial control tends to be related around things like reimbursements. If you're reimbursing somebody for specific types of expenses and gas, you're really towing the line as to whether or not they're a subcontractor or they're an employee. Typically, we reimburse employees, or we give an employee a gas card. That's not really the same for a subcontractor relationship. So those are some of the things there that we're going to want to be mindful of. Financial control in terms of, does this person that you're paying as a subcontractor, do they have the ability to do work for other people? Because if they don't have the ability to do work with other people and you have like an exclusive relationship with them, that exclusivity is definitely going to be considered an indicator. Really, it's more of an employee type situation, okay? Also, the potential for profit or loss. That's a huge one here, and that's a really big one in terms of how do we compensate our subcontractors. If for them to truly be a subcontractor, there has to be an element of risk that they could take on a project and perform it and come out of it at a net loss. Because remember, the thinking here is that they're essentially running their own business. They're another business that you're hiring out to do something. If you're going to pay them hourly, no matter what happens on the project, they're going to make income on it. They're not risking anything in the implementation of a project. That's looking very sketchy in terms of whether they're a sub or an employee. Realistically, for it to be a true subcontractor relationship, you should give them a scope of work, you should give them a deadline, you should give them a quality standard and a set rate, and they agree to it, and they either execute it and make a profit, or they don't execute it the way that they thought that they would, and maybe they go over budget a little bit, and they have some of that profit margin at risk there. That's indicative of a true subcontractor versus employee relationship. The final component on here is going to be that relationship test. Written contracts can be useful sometimes between parties, but you need to keep in mind that just because it's written down in a contract doesn't mean it's going to hold weight. So you could write down a contract that says somebody is a subcontractor, but if they are in violation of these other standards, it's not going to mean much. Benefits. If the subcontractor is enjoying any kind of particular benefits from the business, such as using your equipment or your gas cards or your vans, that can indicate a relationship that they would say is more like an employee relationship. How permanent the relationship appears to be. If they have an expectation that they're going to be able to continue doing work for you, that's like in perpetuity or for the next year or something, that's an indicator that it's probably more likely an employee. So all of these things, these are the big overarching elements of what we want to keep in mind whenever we're deciding how to hire people on and how to pay them. Huge tax trap, because like we've said, you need to be tracking closely what you're paying them. You need to have the information on them in order to, make different payroll and informational return filings the way that you need to. And we also really want to make sure we're treating people the right way so that we're not opening ourselves up to the risk of having this reanalyzed and then having a big old tax bill assessed on you for people that you paid in a particular way the last couple of years. That's definitely a headache that none of us want to deal with. The last note on here, as far as the team trap, is just a really quick one that I wanted to mention. It's not really part of the trap, but there were a lot of payroll credits that became available in the last year due to the pandemic around businesses who gave people COVID sick leave, or businesses who maybe had a substantial loss in revenue but kept people employed. You became open for an employee retention tax credit. I wanted to put a note in here because there was some potential savings or credits that people could maybe amend things from last year and get some cash back. We actually did another webinar pretty recently with Hearth talking about some of those credits. So if you have an interest in that, I highly recommend that you reach out to the Hearth team and get a copy of that other webinar where we go more in depth about, do you qualify for those tax credits? Can you get some cash back from last year? So just wanted to put a quick note in there about that one.
Yeah, we're always happy to help you guys out with any of the content for this stuff. So again, feel free to throw that in there. Plus, we'll also reach out to you guys as well.
Mm-hmm. All right.
Cool, and I know we've got probably about 5-10 minutes left, and 2 more to cover. So the next one's obviously the self-employment trap.
Let's go. All right, so we'll kind of speed through these a little bit. Thankfully, this one's pretty straightforward. The self-employed trap kind of plays off of what I was talking about with those payroll taxes a little bit from the last one. If you're self-employed, most of the time, if you are a sole proprietor or you're a partnership, even if you're an LLC, you could be considered like an LLC sole proprietor or an LLC partnership. They all kind of mix in together. You file the business's income on your personal return and you pay a 15% self-employment tax on all of that income on top of your income taxes. So that 15% bite out of all of your business income is pretty huge. And like I mentioned before, what that 15% self-employment tax is the employer and the employee portion of those FICA taxes. So the big takeaway that I like to leave everyone with here is that one of the biggest savvy solutions that you can put in place for helping to minimize the impact of that self-employment tax burden is looking into whether or not being an S corporation could be a good fit for you. If you decide that being an S corporation is a good fit for you in the business, you formalize and make an S corporation election. And basically what it lets you do is instead of every single bit of profit from the business coming through to you and being taxed with that self-employment tax, you put yourself on payroll. You become an employee of the business. You pay yourself a fair salary. Whenever you run payroll for yourself, you pay those payroll taxes on your payroll. And then the rest of the business profits that you're not running through payroll, they flow through the business onto you, but they don't have a self-employment tax anymore. So anything that you take through the business as profit is avoiding that 15% self-employment tax. At higher levels of earnings for the business, depending on how much you're making, you can imagine that 15% bite can be the difference between thousands and tens of thousands of dollars every single year. And it's an election that you make once, you keep yourself on payroll, and you get those savings year after year after year. So that's one of the hugest things that I like to point out to people. If you are paying that self-employment tax, it could be taking a really big bite out of money that you could potentially be pocketing. So that's really the big thing that I wanted to leave everyone with here. As far as type of business, the other note here is that difference between an S corporation versus a C corporation. For most small businesses, most businesses that are what we call closely held, if there's just a couple of owners, a C corporation is usually not going to be the preferred tax strategy for you because of double taxation. So for anyone who's maybe not familiar, a C corporation is considered a person by itself, and it pays its own income taxes. It has a really good tax rate. Everything's just taxed at 21%. That's our standard corporate tax rate, but it pays taxes on every bit of profit. And then if you're a business owner or a shareholder of that corporation, anytime that you take profits out in the form of dividends, you're paying income taxes on the dividends too, and you're going to pay capital gains taxes on them most of the time. So this is that double taxation that we're talking about with a C corporation. Usually not the best strategy for most people, but again, a really good area to get a professional to take a look and give you some more explicit advice to your particular situation. But that S corporation, it's a really common tax treatment, very common for contractors, and a really good opportunity for savings.
One of the questions that I wanted to bring up for this one, obviously I've worked for private equity firms and I've dealt with startups for the last, 20-ish years. And one of the things that you see a lot of is the way a business is set up originally the way that it has to be in perpetuity, or can you make the conscious decision to switch what type of entity you are?
Such a good question, James, which I'm sure you know the answer to because you've worked in that private equity field for a long time. Thankfully, the answer is that you can change. So the big thing here, though, is that the big recommendation is if you don't have that LLC formation already, get it as quickly as you can. Whether or not, if you're not going to make an S corp election anytime soon, it's still better for you to go ahead and organize as an LLC for the liability protections. But basically, because if you want to do anything else with yourself, you really need to have that LLC in place in order to become an S corporation or in order to become a C corporation. If you're just a sole proprietor or just a partnership, you're going to have to do that formation and then organize as a corporation on top of it. So there is flexibility to change. You can organize as one type of corporation and then swap to the other. So I would say you can use, probably the best explanation is that if you're starting simple, you can level up, and at the higher, more complicated levels, you can swap back and forth between corporation type. You're not going to be able to go from a C corporation to a sole proprietor. So you can go up, but you can't go down.
Perfect. Yeah. And again, I think the biggest thing to note, you guys, is don't make these decisions by yourself. Consult a professional before doing any of this, because that's where you can get really screwed long term.
Yeah.
So, and I know we're coming up on time. Let's jump into number 4, and then we'll open it up to Q&A for everybody with the action steps.
Perfect. Yep. And this is an easy one. Basically, I just touched on this already, the paperwork trap. Everything else is just a function of having your ducks in a row once those deadlines hit. So this is really the one piece that you want to have addressed so that everything else is easy. I say divide and conquer. And by that, I mean, keep the business stuff separate from your personal stuff. It just makes it so much easier when you're trying to organize this information and get all of your things filed. Divide it, conquer it that way. Paperless and your software stack and make it easy all go together. We live in a digital age, you guys. It's a lot easier to keep everything on the cloud, snap photos of anything paper that you have and keep it stored in a digital receipt drive. One of the ones that we really like to use is called Dext, also known as Receipt Bank. Snap photos of things, don't juggle paperwork. It takes up space. It's a lot harder for you to keep track of. Make this easy on yourself. Use software that integrates with your CRM system, your accounting system, your receipt collection system to just make juggling all of this easier. If those systems talk to each other, that means you're doing a third as much work as you used to have to do. Your accounting team is doing a third as much work. So at the end of the day, what we're discussing here is trying to make some behavioral changes, some habit changes that are going to keep us from losing money when it comes to tax time. And the core of all of those things are going to be make it easy on yourself to make these changes so that they stick.
Yeah, and you guys, there's a reason why we came out with things like Hearth Pay. The reason why we can send custom invoices and collect digital payments. All of that can sync back to QuickBooks. Every bit of that makes it so that you have a digital record of literally every transaction with a customer. So aside from doing the other things like, again, keeping your business expenses separate from your personal expenses, and then other items obviously that are going to stack up as a cost of doing business, period, like, office supplies, things like that, maintenance on trucks, tools, whatever it might be, all of that in conjunction with having digital records of all your customer interactions and payments makes it that much easier once those four major tax deadlines come throughout the year. Yep. So keep that in mind. There's a reason why we did what we did and made it super easy for Hearth members to already actively do this. And if you're not using Hearth Pay on this, you guys need to set that up because it's included in your membership and it's free.
I'll echo that. Definitely step it up, because this is one of those areas where not all service providers, not all systems and softwares are created equal. There are a lot of financing options, a lot of different tech and fintech tools out there that do not make this easy. They will bend over backwards to make it hard for you to know what are you paying in fees, what is being taken out of things. And it's just a nightmare on the accounting side. People just miss out on deductions because they can't even tell what they spent on it. So another reason why, the systems that you guys have going over there at Hearth, we're a big fan of.
Awesome. And then lastly, you guys, let's touch on some of these action items. We want to give you some takeaways. Feel free, if you have questions, start dropping those in the chat so that when we jump into the Q&A, we can just hammer through them.
Absolutely. So to echo some of the points we made before, make a plan about how you're going to make sure that these obligations are met. Who's going to do it? When are they going to do it? How are they going to do it? Once you've got the plan in place, follow it year after year. It doesn't have to change. These things do not evolve that much, you guys, except for maybe some of the rates, some of the deductions. So a lot of the times this plan could be best as just like, who's the tax pro that I'm going to use to do it? When can I expect them to have it done? How do I do it? I just drop the stuff on their desk and they get it done. My other points there, again, make it easy on yourself. Simplify it as much as possible. Divide and conquer. Keep business stuff away from personal stuff. Just makes sifting through everything a lot easier. outsource what you can, automate what you can with your software stack, or things that are automatically digital so that you don't have to take the time and the steps to scan records in. If you have a vendor that's already doing everything online, work with them preferentially. Work with people that make your life easier. That's what we're all about, right? And then point number 4 is just start tracking now. Start somewhere. It's going to be a lot easier for yourself if you just start taking photos of your receipts. Just pay the $10 a month, $15 a month to get a software that lets you take photos of things, so it's all there when you need to sift through it. The tracking of everything is how we prevent ourselves from falling into all of these traps that we just discussed. So make a plan, make it easy, start it now.
Yep. So you guys, let's open it up for Q&A. I know we've gone over a little bit. I know we started about 5 minutes late. Apologize for that because the audio issues on my end. What questions do you guys have? Feel free to open that up. I know we touched on
A lot.
enough content that you probably make your brain melt. But again, that's why you work with an organization like this, which again, we don't need a slide that says Q&A. I'm going to put this slide up in the background. It looks like some of you guys are typing in some questions. Again, this is another organization that we believe in wholeheartedly, and why we brought them in as the subject matter expert on this specific topic. Again, we vet every one of our national partners. These guys blow us away all the time, and we're constantly bugging them for advice on how to do different things within our own product suite. So again, super impressed by them. If you guys want more information on how they can help you out as well, it's bookkeepingfortrades.com. Morgan's one of the partners there, along with Melissa and her husband. Guys, they are absolutely fantastic at what they do. So again, highly recommend if you guys are at all looking to grow and scale, work with somebody, like you said, that's going to make your life easier. They're one of them. So we're going to open this up to everybody again. If you guys have any questions, feel free to drop those in. I know we're a little bit over time, so we might just call it. But again, Morgan, really want to thank you guys for what you do. You guys are awesome and a wonderful partner for us. In the meantime, if anyone again has any other questions or wants to reach out specifically and work with Morgan and the team, bookkeepingfortrades.com. For those who might be attending this, because I know we're also going to be sharing out the recording. Again, we went over a ton of information. There's no way everyone was able to take notes on all of this. We're going to send you out all of this in a recording. So again, you guys can go through this at your leisure. If there is somebody that's actively looking to dive into Hearth a little bit more, you can always go gethearth.com/BK for trades. Again, there's a lot of really cool things that we can do. If you're an active Hearth customer already and you want more information on how to use things like Hearth Pay, which is a digital payment tool, again, we're always happy to help you guys set that up. Feel free to reach out to us. It's just support@gethearth.com. So I'll go ahead and drop that in the chat. Otherwise, you guys have been awesome. Go ahead.
While you're on that, James, I was wondering, is there going to be a shareable recording of this webinar available?
Yes, there is. So I'll make sure that everybody has a copy of that, plus a link for anyone to send out and share to their friends as well.
Very cool. Yep, share the love.
I'll post on your site.
If it saved you any money, maybe it'll save someone else some money too.
Yes, absolutely. So we'll go ahead and get those out to you guys. Again, thank you for taking time out of your day. I just put the link in there, or the email address, support@gethearth.com. You guys can always reach out. We're always happy to walk you through Hearth Pay, etc. But again, Morgan, thank you so much for you and your team for what you do. And without further ado, you guys have a great rest of your week, and we'll talk soon. Awesome. Thank you.